All right, welcome to the weekly roundup. What is it? January 20th, 2023. I'm Scott, that's Ben. And the
Hello.
third guy, it's a special edition because we got brought on a special guest to talk about everything that's going on with the rates and mortgages and stuff like that. We thought in the real estate market, we thought it'd be a good idea bringing a specialist, but I'll kick it over to Ben and he can introduce our guest.
Right on. Super. Thanks, Scott. Well, welcome everybody. Yeah, we're excited to have Mickey Gilchrist on with us. Mickey is one of our colleagues at the bank. He's a mortgage specialist, mortgage financial specialist. We've worked together now for a while and sent Mickey some clients, and they've been super happy with him. So, we thought it might be a good idea to start to provide some other piece of information that can help you with your planning. We've had lots of feedback from clients around, what else can the bank offer? What are some of the things they can do? And we thought it'd be a good time to have Mickey come in and a little bit talk about himself, what's going on in the rate market, what's happening in mortgages, what he sees, where we're in good shape. He'd mentioned there's a good transfer feature that we have in place right now. So looking forward to having Mickey talk a little bit. So Mickey, why don't you do a little introduction and then we can go through some questions.
Sure. Thanks, Ben. Hello, everyone. My name is Mickey Gilchrist, and I've been a mortgage specialist with National Bank. I'm going into my 13th year now, and I've actually been doing this role the entire time with the bank. And I've always, I've had opportunities to look at other lenders, but I just find National Bank, we remain, especially with the banks, the most competitive from like wanting business, wanting getting deals approved, and interest rates as well. So it's been, I've had a lot of success working with the bank, and it's been, it's becoming challenging times. I mean, the last 2-3 years have been quite the roller coaster of lending. And my sort of I specialize in basically all residential lending, from your standard sort of primary residence to rental properties, real estate portfolios. I can do up to like a 4-unit rental property. Beyond that, we have other departments for that. And we also do specialize in a lot of construction financing, which I find is really popular now, with whether it's just a renovation or just a complete sort of tear down and start over. National Bank is a really favorable program for that. And also we have some other sort of special areas with I mentioned before, our rental program for people with sort of bigger real estate portfolios. Or if people who want to get into sort of financing their properties under a company, like a holding company, we seem to be sort of the most flexible there. So National Bank's a great partner in terms of we are open for business. We're hungry for business, and we also seem to maintain a very competitive on the interest rate side, even though, as I'm sure most people are aware, that the rates have been quite a bit higher today than they were about a year ago. But I don't know if you want me to sort of get into that now. Or,
sure. So no, I know we've talked about a few deals that you've had, you've been able to get through and successful for people. And I've found working at a number of institutions myself. Every place is a bit different, but from what I've seen in our conversations, once you've committed and put a deal in place for a client, it seems to it always happens. Like once you've committed to it and have it done, put in place, it happens. So maybe you can talk about what the markets look like. Obviously rates have gone up and down, and a couple of spots where you think we're competitive, and maybe talk about the transfer option that you'd mentioned to me.
Yeah, and to what you were first saying, I mean, National Bank, nowadays with the qualifying standards being so difficult, it's not everyone, it's easy to get approved. Like a lot of times we're trying to fit a circle into a square. And, National Bank, just with having sort of being able to go up the chain pretty fast, where we can, if it does make sense, we can make exceptions and get deals approved. So that's one huge benefit in this time when it's, the criteria is so much tighter. But yeah, so I mean, we've seen, we had that when the pandemic began, the rates just free fell. At one point, I think we were doing fixed rates around 1.5% and variable rates close to 1%. And that was the brief glory days. And now we've seen, the fixed rates went up to as high as, I think our 5-year fixed hit a peak of around 5.6 or maybe 5.7%. But we've already started to see a decline in the fixed rates, as we did expect. Like our 5-year fixed has actually climbed down to just over 5%, and it's actually just kind of whispers it'll be under 5, like a 4.99 or 4.89 pretty soon. The shorter term fixed are still up a lot higher. They're still in the 5.7, 5.8 range for like a 1-year or 2-year fixed. Interestingly, the 3-year fixed, which is sort of that, is it a short term or long term? It really dropped this week. It was closer to the 1 and 2 year, and it dropped to like 5.14 this week, which is much closer to the 5-year fixed. So I think that might be sort of a sign of what we've been seeing with the bond markets and everything, that the fixed rates may, continue to slide down, even, before the variable rate. Variable rate is still, though, one of the most popular strategies, I would say. I mentioned the 5-year fixed is under 5%, but I don't see anyone taking that term really. It's still a high number to commit to for 5 years, but I see basically half and half. People want to go variable or want to do a 1 or 2 year fixed, and the variable prime rate is still up at 6.45. The discount, especially historically, is not that great. We're around like prime minus 0.5, so today your starting rate is right around 6%, versus the fixed rates, which are, the 5 being almost under 5%. It's an unusual time where the variable rate's that much higher, but people are still putting their faith into that strategy, knowing the 3 months to 6 months or maybe longer might be a little bit rocky, but the variable is a 5-year term. So
maybe just sorry to interrupt though, maybe just on a a variable, excuse me. So all the banks are a little bit different on how they pay it. So once you put a variable rate in place, and you fix your payment there, right? And then what happens if rates start falling? What happens to the payment? Does it change or is it the same?
Yeah, actually, in our case with the bank, we have a variable payment as well. So a lot, all the variable rate holders with National Bank over the last year have seen their payments jump. And well, it's gone up a little bit each time. Alternatively, I mean, the reason we do that is it keeps clients on their amortization schedule, which they have to. There are some lenders that have sort of maintained the payment constant, but they're paying 100% interest at this point. Actually, they've been paying 100% interest for months, and when their term comes up for renewal, they got to get back onto their original amortization schedule, and that's kind of that trigger point you hear about in the news. That could be a huge problem. Our case, like the payment can go down, like as the rate goes down, and also your portion of principal versus interest, you're starting to pay the principal down a lot quicker. So it's that's the main reason why still are going variable with the hope it'll go down.
So does that happen right immediately? Say I'm paying 3,200 and the rate goes from, 6 to 5.5. Next month I get adjusted down to 5.5? My payment comes down.
If it's a fixed rate, it wouldn't change. It would stay the same.
Variable.
But yeah, the variable can go down. You can also keep it the same if you preferred to focus on paying your principal faster.
I see. Okay. Just last one, and then I'm gonna jump into my side of things here, but maybe talk about the transfer option that we have for people.
Yeah. I see this year, especially, everyone's afraid of if your mortgage is coming up for renewal this year. It's a little scary knowing what your rate may become. And I think whatever institution your mortgage is at now, I think it's more important than ever to sort of shop your rate at renewal rather than just take what your lender offers you. And National Bank actually just rolled out a promotion this week that will last most of the year. Goes till October, where we'll just cover your transfer costs. So there's a legal fee that's usually around $850, and then sometimes an appraisal fee, which is another about $300 with us. So we just can cover that entire amount, about $1,200, and it has no impact to the rates we can offer. So we can still offer like the best rate we can. So I do expect myself and really National Bank will bring a lot of business over for people who are renewing or just looking to refinance, and it'd be a good time to do that.
Fantastic. That's awesome. Listen, thanks Mickey. We're going to pass along your contact details and stuff to clients, but I appreciate you taking the time, giving us an update. We'll have you in again sometime this year. I think this is a great opportunity for some clients to hear. Maybe they have kids as well that might be looking to buy properties too. So certainly we'll make sure to connect you if that happens. So thanks so much for joining us. You can stick around and watch if you want, but I'm gonna jump in. Thanks. I appreciate you joining us on a Friday.
No problem. I'm used to being the audience member. So thanks.
Perfect. Thanks, Mickey.
All right. Take care. Thanks.
Yeah, you too.
Well, that was awesome.
Yeah, that was great.
Yeah, really good.
Yeah.
I think that's the plan for this year, right, Ben? We're going to do that more often. We're going to bring in, mortgage specialists, maybe some tax experts, estate planners, stuff like that. Good.
Trying to do our best. I mean, I think the variable rate that they talk about, which is different, right, is that you put your payment in, and as rates come down, which is what I've been saying and expect, it's probably a reasonable time where that your payments are likely to be lower in the future. So I think it was good
to know.
Good start. Yeah.
Great. Okay. Well, let's get into our usual shtick and zip through here.
Okay.
Just give us a quick recap on the week there, if you don't mind.
Yeah, sounds good. I was just looking through the week here. It was a more volatile week this week. To your point from our earlier conversation, lots of job layoffs. Google announced they're firing 12,000 people today because of the economy and because they want to fund their future investments in AI. And so I think it's interesting to see the significant amount of money that's going towards AI right now, with Microsoft just announced a giant investment in AI as well. So that's not good for the jobs numbers, but we had Amazon and I think Netflix as well announced some job losses. But from a market perspective, TSX was flat, S&P and NASDAQ were a little bit negative for the week. Bonds were slightly on the positive side, both in Canada and the US. And Ethereum and Bitcoin both had good weeks. ETH was up 8 and Bitcoin up 14%. And then just a quick snap on the year. I just took a quick look through, and we got NASDAQ TSX slightly up, where NASDAQ and S&P up kind of 4 or 5%, and Ethereum's up close to 40, and Bitcoin's up north of 40% year to date. So lots of good news out of the gate here, but I'd say that's it from a quick update on the week.
Good stuff. I have a big question from Dave here that we'll answer after the slides. So if you want to jump into those.
Okay, super.
And by big question, I mean three-parter.
That's
Three-part
three-parter. Okay, super.
Which we love,
Let me
Dave,
know
by
when
the way. We love those.
Yes, yes. Okay, so can you see that? You're good?
Yep, we're good.
Okay, perfect. So yeah, lots of data to come through, but as I said, for those of you who joined the annual presentation, thanks very much. Appreciate it. We had good feedback, lots of interest there. But my point at the time was really what's happening with where inflation's going, and the central banks, whether you love it or hate it, tend to use a core inflation as their number. And when we look at core inflation, it strips out food, energy, and mortgage costs, which is pretty much all we pay for. But their inflation numbers back in their band. And so, when you think about where we go from a rate perspective, we think next week that they're on hold. Consensus is a 25 basis point increase, but NBF thinks we're on hold. And with this data that's coming out, you can understand why that's the case.
Gotcha.
Yeah. U.S. housing, obviously housing in both Canada and the U.S. are slowing down at a dramatic pace, but this chart grabbed my attention because this is a big time outlier. Just the pace at which the housing market's corrected in both Canada and the U.S. is off the charts. And so when we think about at what phase of the tightening cycle we're at, this is another reason why I continue to believe that we're quite late in it. And just to point, I've had a few questions where people say, well, is this going to be like 2008? My view was 2008, particularly related to U.S. housing, was nothing to do with the housing market. It was more to do with the leverage, the credit default swaps, the leverage on top of leverage, the securitization of crappy assets. So much different today than it was in 2008. Two last quick ones. One is just as we continue to follow ESG, and I've commented on nuclear a couple of times. This really grabbed my attention this week, and as I say, this is kind of green energy in a lot of people's eyes. When you look at the information and people do surveys and things like this, you can see how split it is. Kind of 50% of the population wouldn't be comfortable living within 100 kilometers of a nuclear power plant, which for me is shocking. I grew up very close to Bruce Nuclear in Southern Ontario, and I don't have any concerns that there's going to be a massive earthquake in Ontario or something like that could cause a nuclear meltdown. But the world still continues to be divided on that. Particularly, this is Canadian data, so I was pretty shocked when I saw this.
Mm-hmm.
So the big news for next week, and then we can hit on to the questions here. But the big news for next week, certainly Bank of Canada on Wednesday. There's about something in the neighborhood of 40 or 50 companies reporting next week. Microsoft, I believe, reports on Tuesday, but this is Wednesday data, so you'll see Tesla's coming out before the market on Wednesday. Same with Bank of Canada, mortgage applications in the U.S. So lots of information to come out next week, and then the following week will be U.S. Central Bank, February 1st, with their rate announcement.
Gotcha.
Mm-hmm.
Yes, they're anticipating a raise in rates again, eh?
Who is?
Sorry,
US,
what?
US?
Is it the US?
So
I thought I read today
consensus
they're
is-
anticipating a raise in rates, like one final one.
Consensus is we don't agree, National
Right.
Bank, but
Right.
consensus is
Yeah.
25 basis points in Canada.
Yeah. Okay. We don't agree. That's great.
Yeah.
I think everybody be on our side if we were correct. Okay, let me just jump into Dave's question here. It's actually a four-parter. What would you propose for the portfolios if one or more of the following events occur? One, the US bumps up hard against the debt ceiling or defaults. Two, do you want to answer them one at a time? Or
No, go ahead.
Rip them off here. Number two, the rise of COVID in China reignites the pandemic worldwide. 3, the spring offensive in Ukraine triggers a significant east-west confrontation. And 4, inflation continues to be stubborn and unemployment remains manageable for the next year, and central banks maintain relatively high interest rates.
Okay, so these are great. Always
Whew.
great questions that challenge and flex my mind here a bit. So, debt ceiling default. Certainly, they're pushing up against. They've essentially been in at the debt ceiling since November, plus or minus. They've been riding that line since then. So I think that it is something less that's worried about now, less than it was a couple of years ago, and there continue to be battles around raising that ceiling. So I expect they continue to raise that. It's a self-imposed mandate that ultimately they may get rid of at some point. As for a default on the US dollar, certainly a possibility. I don't think it's a likelihood right now. What would do well in that environment? That's a great question. I mean, I think gold would be your kind of safe haven asset in a default of that nature. I don't think it's likely because I think that'd be financial Armageddon, but certainly that gold would probably perform best in that backdrop. As for the China COVID, I think it's certainly something that Xi will battle with. They've been closed for 2 years. We see how much damage that's done to the Chinese economy. The Chinese housing market is in disarray. You've seen that their population actually shrunk for the first time in a very long time, many decades. So a reversal slash spike in COVID. I think a spike in COVID is absolutely happening and will continue to. But I don't think a reversal on policy is one of the things that they're considering at this point. If they did do that, obviously world slows in that backdrop. It's probably not, the faster slowing probably brings inflation down quicker. Maybe rates fall. Maybe you want to own some US dollars in that backdrop. But those two obviously are conflicting, point 1 and 2. Point 3, if there's an increase in the igniting of the war. So again, I think we'd likely see more of what we saw early this year, which is a spike in commodities. We've seen obviously natural gas come down effectively to where it was 12 months ago before this started. So I'd anticipate you probably see a spike again in nat gas and likely oil. Like presently, it looks like oil is range bound in the 80 to 90 range, but you'd see spike in those two. You'd see a continued spike in US dollar, and probably rates fall faster as you get intervention from central banks quicker than what we're seeing right now. So again, you probably want to own bonds in US dollars in that backdrop. And the last point is probably the one I'm worried about most, is inflation stays sticky. And the central banks keep their finger on the pulse of everybody by continuing to press on pushing inflation down quickly. The last thing that they've hung around with, which it was the strong housing market that we're seeing in Canada, US. And so to the point earlier, there's been massive job cuts, and we're starting to see that filter out into the system quite quickly here. And so those are some deflationary pressures, but inflation staying sticky and an ongoing or escalating war is certainly a one that could challenge my current thesis, which is inflation falling and growth is falling. So you probably don't want to own risky assets if you get a war increasing and inflation staying sticky. So I'd say in points kind of 2 through 3, you want to own US dollars and bonds. And point 1, you probably want to own some gold. So hopefully that answers your questions. I know that we could certainly go into more detail if you want, but I think just off the cuff, that's how I'd view what and how you'd want to be positioned in those backdrops.
Okay, just to wrap up, what are we looking at for next week?
So earnings continuing coming out next week, and as we watch those earnings, we watch the job numbers to that point. Bank of Canada on Wednesday. Let's see what happens there. Are they done, officially done, or do they do one more time? So that's a big data point. Those two, be watching.
Great.
Yeah.
All right. Anything before we kick it off for the weekend?
No, I think that's it. So I appreciate everybody that watched the annual. If you have anyone you know that's interested in watching it, please send along as well. Any feedback's welcome too. We've had some good comments around how we can continue to refine it and do it better. And so we're taking that and trying to continue to make our process better and give you more information, educate you. So I'd say that's it. Anything from you?
No, that's it. Yeah, no, that's pretty much it. TFSA contributions keep rolling in. So if anybody, I think we've done a lot of them now for this year. A lot of people like to jump on those right away. So obviously the limit increased 6,500 this year. So that's a nice little bump for everybody. So yeah, that's it. That's pretty much it.
Perfect.
Yeah. Okay.
Awesome.
Well, thanks everybody for joining, and we'll see you next week.
Perfect. Thanks. Take care.
Yeah.
Bye.